To input prices, again, over the last couple of years, we've seen these prices go up, and if you recall from previous discussions, we've been concerned about that, particularly in terms of what's going on in the land area. But fertilizer prices don't look like they're going to show much softness here over the next year. The seed prices don't appear to be going down as well, and chemical prices. Petroleum prices down a little bit, but it isn't showing up yet in terms of fuel prices, at least in terms of diesel at the level we would like to see it show up. So generally, and this is not unusual, costs are pretty lethargic to adjust down very rapidly. Probably the biggest challenge that farmers are going to face this year is because they are going to have these negative margins for most of the corn, bean, wheat, and other crops that they're going to be producing. They're going to be working really hard to try to get prices and costs down, but it's going to be hard. Rents probably will not adjust down very much. And on the other hand, one way to get some of these reductions in the cost side is to be a little smarter about how we use some of our inputs. So we do expect to see farmers be a little more selective on whether they buy the seed with all the traits in it and pay those premiums. We expect that maybe there will be some fungicides that were bought last year that probably won't be bought this next year. And so generally we see the industry that's going to have, on the input supply side, going to be facing a group of producers who are going to be pretty aggressive in their negotiation. The incomes are going to be down, according to USDA projections, somewhere around 13 to 15%. When we look at the numbers, farmers are going to probably end up having negative margins of, say, on crop production, corn, soybean types of land, of $100 or more per acre. One of the first responses that farmers make when they get into this kind of a margin compression is they just quit buying machinery. So machinery sales are down already. Some very significant declines in what's happening out there in terms of selling of machinery at the retail level. High horsepower tractors are up 15 to 18% in terms of sales, and we expect that's going to continue here. So those are the kinds of adjustments that farmers are going to try to make. Probably what's going to happen mainly to protect those margins is and protect the cash flow side of the business is very little capital expenditures on the part of farmers this next year.